Welcome all to our Broking Breakfast seminar. For those of you who don't know me, my name is Paul Goldwyn, and I'm a partner in the Financial Services Division here at PKF Littlejohn, specializing in insurance intermediaries. By way of introduction, today I'm going to be speaking about wind-down planning, following the FCA's recent thematic review on wind-down plans, and then following their multi-firm firm-wide survey. And I'm then going to do a short session on Part 4 applications as they affect UK branches, linking into the CAS 5 permissions, as we seem to have had a lot of inquiries on the subject. I'll then be passing on to my colleague Richard, who will be talking about consumer duty and how it affects insurance intermediaries. And then Richard will hand over to John, who will do an update on broker M&A and the findings from our various FDD reports and transactions. So to start off with, I will talk about wind-down planning. It's very clear from the FCA's 2021-22 business plan that the whole issue of financial resilience and resolution was one of their overarching priorities across all sectors. You will all be sick of the financial resilience surveys that the FCA have continued to send out. I think I counted a total of 11 that one of my smaller brokers had recently since the start of COVID-19. And this won't go away. This will now be embedded in the RMAR reporting process under the new baseline financial resilience regulatory return. So it's very clear that the FCA are still concerned about financial resilience. They still see a lot of firms with weak financial resilience, and the current and the looming macroeconomic sort of conditions do not help. The regulator expects firms to have sufficient capital and liquidity, and if they don't, the regulator expects firms to tell them and to put in place plans to shut down their businesses in an orderly manner. So the FCA expect firms to have a well thought out wind down plan in place to demonstrate how they will exit the market in an orderly manner without causing undue harm to customers and markets. Just to take you through the guidance on this, the FCA published their first wind down planning guidance in June 2020, and then they refreshed this in August 21 amid the continuing COVID-19 concerns. The FCA has also reminded firms of the need to constantly comply with Threshold Condition 2.4, both throughout a period of activity and also during their wind down period, ensuring that firms have adequate financial and non-financial resources at all times. And the FCA has also reminded firms of its obligations under the Principles for Business, and in particular, Principle 4, the need to maintain adequate resources throughout. So moving on now to the actual wind down plans themselves. Firstly, just to say that this applies to all regulated firms. It's a popular misnomer out there that you only need to do a wind down plan if you're in financial distress. Well, that would be too late. It applies to all regulated firms, not just those in financial distress. There's no actual set template or pro forma for the document. It just needs to be tailored to the firm's own circumstances. And the objective is to reduce the risk of harm on consumers and markets when firms wind down their business. In theory, this will generally consist of the following components. There will be an evaluation of the various scenarios that lead to the wind down, and this is known as the trigger event. There will be a plan put in place to steer the firm in an orderly manner. There will be an assessment of the financial and non-financial resources required, and then there will be a process for identifying and mitigating the material risks and obstacles to the orderly wind down. In practice, what does this actually mean? In practice, there are really two components to the wind down plan. There's the actual financial projections and modeling with the detailed assumptions and the identification of the actual TC 2.4 buffer required to affect the wind down process. And this will be accompanied by a detailed practical narrative plan setting out how the orderly wind down will be achieved. In practice, we see that firms do great modeling, have great sophisticated financial projections, but where they tend to lack is in the actual detailed practical narrative plan that sits next to the projections and actually explains in detail how that wind down will actually be achieved. Also to say that this is not just a task that is delegated to somebody in the accounts department and the wind down plan is prepared and then put in a drawer and forgotten. This needs to have the buy-in of the actual governing body of the organization. So it normally needs to be approved and effectively ratified by the board of directors. And the end result is that the firm will want its Part 4 permissions cancelled by the FCA, and they're not actually going to be cancelled until the FCA is satisfied that they've got a proper wind down plan in place, that it's been properly effected, and that an orderly wind down has been completed. So moving over now to the FCA's various reviews. The FCA started with a high level thematic review, and they looked at a whole variety of wind down plans in the market, and they concluded that most of the wind down plans that they did look at were at a very early stage of maturity with what they called substantial gaps. And they also concluded that significant work still had to be done to meet their minimum standards. And they looked at three main key areas of weakness that they identified in firms' wind down plans. And these were the areas of liquidity, intra-group dependencies, and the actual process of identifying the trigger event. So if we start with liquidity, it's clear that firms need to demonstrate TC 2.4 compliance during the wind down period in order to avoid falling into what they call a disorderly wind down. And the FCA generally found that firms were good at monitoring their capital needs. There was very good sort of modeling of capital resources versus capital requirements, therefore ensuring that solvency was maintained throughout. But they weren't so good at monitoring and effectively modeling their liquidity needs. And effectively, as part of the wind down process, firms need to demonstrate that they can calculate their TC 2.4 cash buffer, i.e. the amount of money that they're going to need throughout the period to effect this orderly wind down. And they need to show how these funds are effectively kept within their accounts. And normally they would be ring fenced in the form of a separate sort of office account with sufficient funds in it to be able to access in case of wind down. Firms also, the FCA found, need to better demonstrate how they will fund any cash flow timing mismatches in wind down planning. For example, if they're planning on selling their principal sort of trading subsidiaries, there will be a period after they've effectively pressed the button to wind down where they won't have necessarily the inflows in place to be able to match the cash outflows that are required, and therefore they would need to have sufficient funding in this particular time to be able to sort of fund that cash flow mismatch. They also need better handle of the overall calculation of the net cash impact of the wind down, ensuring that they remain cash positive throughout. And it might seem very obvious, but they need to effectively start the wind down process with a healthy cash balance in order to avoid entering the wind down sort of planning phase in a state of financial distress. That was liquidity. The FCA also looked at the area of intra-group dependencies as an area of potential weakness. There are many large broking groups out there, and the FCA permits the wind down plan to be actually looked at on a group basis, as long as each regulated entity is separately covered and the entity view is available for these regulated entities. The FCA found weakness in the firm's assessment and mapping of the interconnectivity that exists in groups and the impact on the wind down. And in particular, they found issues around financial interconnectedness, particularly in situations where parent group support is available and in place, operational interconnectedness, and this is where there's sharing of group resources, for example, HR, IT, etc. And also they found issues around the whole concept of contingent financial support, where companies may be subject to group cross guarantees, etc. And in relation to these intra-group dependencies, the FCA found insufficient documentation and mapping of the governance structures in place, showing the interaction between the various boards to understand where the wind down planning decisions were made. And they also found insufficient documentation and mapping of the operational plans and the impact assessments, setting out which entities were being wound down and how. And finally, the third area in which the FCA sort of found issues as part of their high-level survey was the whole concept of identifying the wind down trigger. And often it will appear that firms would do their modeling, they'd put their plans together, and then think about the trigger afterwards, making it fit, rather than having the trigger as the initial sort of initiation point for the wind down plan. And the FCA takes the view that it's not just one trigger that you need to think about. You need to look at the whole range of triggers that could lead to wind down, and look at these in relation to the firm's risk register, because failure to consider various options can potentially lead to delayed decision making when the firm is already in distress, therefore maximizing the chances of poor wind down outcomes. And this is certainly an area that we have found to be a weakness in firms' wind down plans when we've actually sort of assisted firms in evaluating and advising on their wind down plans. The whole issue of identifying the correct trigger has always been something that firms have tended to find is quite difficult. So in addition to the high level survey, the firm also in September, the FCA rather, also in September 2022, conducted an FCA multi-firm survey where they actually went a little bit deeper into firms' own wind down plans, and they published their detailed assessment of this in September 22. They only actually sampled 10 GI brokers, and they mainly looked at the larger London market commercial GI brokers. I've still to find a broker who's actually been part of this survey. I've asked quite a few of my clients and the firm's clients, and nobody seems to have been part of this survey. But what the FCA have said is that as a result of the results of this survey, they will continue engaging with the GI market up until 2025 on wind down planning. So if you take away anything from this seminar, please ensure that your wind down plans are up to date, as you may well be picked in the next round. The FCA assessed the credibility and operability of firms' modeling of minimum liquidity required to achieve an orderly wind down. And they found that although most firms that they'd sampled had adequate wind down planning arrangements in place, many of these had not been updated for some time and were now clearly out of date. There were some good examples of good practice, but most of them showed room for improvement. And effectively what the FCA now wants is it's encouraging firms to compare their own wind down planning arrangements with the findings from this survey to ensure that standards are improved where necessary. So I'm going to share with you now some examples of good practice and bad practice, and this has arisen from the FCA's findings. So in terms of good practice, clear identification and regular reviews and mapping of the risks inherent in their business plans, using the risk register as effectively the main document from which these reviews and this mapping can take place. A strong consideration of the harms that could arise from these risks and the steps needed to mitigate them. Detailed and well thought out capital and liquidity projections with the accompanying narrative plans, therefore assisting operable and credible planning. This comes back to the point that I mentioned earlier of our own sort of findings, where firms are very good at doing the well thought out capital and liquidity projections, but not so good as preparing those accompanying narrative plans. The FCA also found that examples of good practice are where there is good stress testing embedded in the risk management framework, therefore providing a better and broader view of the likelihood of these risks actually crystallizing. And the FCA also found that where there are regular reviews of these wind down plans and modeling of the minimum liquidity, this tends to lend itself to much better wind down planning than if it's not sort of updated at all, as in fact they did find in quite a lot of cases. So moving now to the examples of poor practice. This is almost really like the opposite of the good practice. There was a weakness in embedding the firm's risk management framework in process, so therefore not really using the risk register to identify those triggers, a lack of risk metrics and monitoring, and really being unable to determine if the firm is operating within its risk appetite, poor MI, hindering firms' ability to make sound decisions, inadequate quantification of the probability of risks or the potential impact, limited granularity in the firm's capital cash flow monitoring, so poor cash flow monitoring as a result of a lack of detail and possibly superficial analysis. And again, as I mentioned earlier, the absence of or very poorly documented narrative wind down plans. So their examples of good and poor practice. So effectively, in conclusion, um, the FCA will very clearly continue to assess the firm's financial resilience against their minimum standards. It's very clear from the various business plans that they are still concerned about financial resilience. Firms need to be financially resilient. They need to have strong arrangements in place to protect clients and be able to recover quickly from any sort of economic or operational disruptions. And if they're unable to, the firms must shut down their operations in an orderly manner without causing undue harm to markets and customers. And this is where having a good, well thought out wind down plan is critical. So the FCA now, through their various engagement with the markets, are aware that this is an area of weakness and it's an area of concern for them. And therefore, they will continue to engage the market. So as a takeaway, ensure you are prepared. There will be more from the FCA on this next year. And you need to ensure that you have those wind down plans in place and updated in case you're in the next survey. Thank you. I'm now going to talk very briefly on Part 4 applications for UK branches of EU intermediaries and how this links into the CAS 5 permissions. As I said in my introduction, we've had a lot of inquiries from this, and I just really wanted to explain the background, explain where we are, explain what can be done. I don't really have the answers to this, as they're still very much up in the air, but hopefully I'll be able to put some of this into context. So those firms that have or still have a European business, as part of their Brexit planning, will have set up EU intermediaries and then created a UK branch of that EU intermediary. And this is the concept that we've all heard of, called back branching. These UK branches of EU intermediaries operated and still operate in most cases under the TPR, the temporary permissions regime. And what the FCA has been doing over the last year or so, it's been awarding landing slots and inviting these branches to apply for Part 4 permissions to become fully authorized by the FCA. The actual deadline for application for full authorization for UK branches and for non-UK branches is the end of this year. So we're soon reaching the end of this process. And what we've been tending to find is that in anticipation of this full authorization, many of the UK branches set up identical systems to the UK authorized firms that they were aligned to, particularly around client money systems. So for example, they would be carrying out client money calculations every 25 business days. They would have set up NST bank accounts, which wasn't an easy process. In some cases, they would have appointed client money auditors in the relevant jurisdictions, all really mirroring the system in place for the UK authorized entities, because the expectation at the time was that these branches would fall under the jurisdiction of the FCA for client money purposes. So where are we now in terms of the Part 4 application? Well, effectively, I mean, these branches, the expectation of receiving FCA approval was really justified, because when they actually submitted the Part 4 applications, there was a little section where they needed to tick a box to notify the FCA if they wanted client money permissions or not. So really at the time of submitting this application, they kind of felt that they were going to be under the FCA jurisdiction. And those firms that ticked the box and required client money permissions were also required to submit an auditor certification of the adequacy of their systems and controls for the purposes of holding client money. And in fact, we did this for quite a few of our clients. So lo and behold, come early 2022, the whole of the market was rather shocked when the FCA sent out a policy decision and a policy statement stating that UK branches of EU firms should not hold or control client money. And therefore, the message was that the FCA was not giving UK branches any client money permissions. This really shocked the market, and we had a lot of inquiries on this, a lot of firms not really knowing where to go next. I mean, the FCA's logic of this was that UK branches should obtain client money permissions from their own relevant home state regulator rather than themselves, rather than the FCA. But unfortunately, this process was easier said than done. The FCA effectively wants to ensure that the client money rules for UK EU branches is consistent with the jurisdiction applied in case of the insolvency of the EU intermediary. And to be honest, this makes sense because the FCA would not have jurisdiction of the EU intermediary if it became insolvent, and therefore it couldn't protect client money. So how can it possibly regulate client money? All makes sense, but unfortunately the whole area and the whole process of how this was communicated was a little bit last minute for a lot of firms, leaving them in a position where their expectations were not matched by the actual reality of what happened. So where are we now? What's happening in practice? Those firms that actually hadn't yet submitted their Part 4 applications have obviously learned from those that have and are now not ticking that box. And effectively not applying to the FCA to have client money permissions because they know that they're not going to get it. Or in some cases, to avoid having to submit a new application, they are now going back to the FCA and telling the FCA that client money permissions are no longer required. And those EU firms and the UK branches thereof are now seeking those client money permissions directly from EU regulators. And once they've got that permission, they're informing the FCA that they've done so, and that has then enabled their Part 4 applications to be cleared and granted. And we've seen some examples of consent having been given, particularly from the Italian and the Dutch regulators. Clearly, some jurisdictions are far more sort of willing to do this than others. However, some other EU firms have been unsuccessful in getting client money permissions, with their applications still very much open and in limbo, and they continue to be under the TPR. Greece in particular is particularly unhelpful. They just don't recognize the concept of client money at all, so they're not giving any sort of client money permissions. Other jurisdictions, Belgium, for example, they are delaying consent as they don't quite understand what is being asked here. And they're trying to be helpful, but they're trying to work it out through their own systems. And it's very obvious to me that, client money in the EU is not regulated as robustly in the UK at all. It very much varies on the jurisdiction. And as a result, there is no sort of standard method of getting these client money permissions from the various sort of EU regulators. So what can be done? At the moment, there's no real clarity for those UK branches that are stuck in the process, be it as a result of client money issues or others. In fact, I've been talking to some brokers where it's even a step before the granting of client money permissions. In some cases, some regulators aren't even granting those EU intermediaries permission to operate under a UK branch business model. So we haven't really even got to the client money permission issue at the moment. They're still stuck on the whole concept of whether a UK branch is permitted or not. It's clear that these various sort of UK branches can't remain in the TPR indefinitely. At some point, the TPR will close, and perhaps we'll get some clarity from the FCA next year, post the 31 December 22 deadline for the submission of the Part 4 permissions. Where the EU regulator does not recognize client money and the UK branch is holding client money, the insurance funds held by the UK branch would need to be handled logically under a risk transfer arrangement. or firms could also consider withdrawing their applications if they're not in the TPR and making the EU branch an AR of the UK FCA registered entity. That's still possible, although if this arises as a result of a problematic Part 4 application, the FCA may take a dim view of this, particularly if they're able to sort of join up the dots and see that it's the same applicants. So really, apologies for not really being able to give you any sort of definitive answer on this, in case you were coming here wanting an answer. It's really very much a case of watch this space, and of course we will update the market as we hear more. Thank you very much for listening, and I'll now hand over to Richard.
Paul, thank you very much. It's evident for us to see that the FCA is taking a much more proactive stance, and this is circulation across all lines of engagement with the market. My name is Richard. I'm from PKF's GRC team, that's Governance, Risk and Control Assurance team, and I'm going to spend the next few minutes taking you through a brief presentation on the Consumer Duty. The first question is, how do we get to Consumer Duty in 2022? Well, if we look back, we start at a state of treating customers fairly, and I'm sure everybody attending today will be reasonably familiar with treating customers fairly. We progressed through the non-financial conduct initiatives and guidance provided by the FCA, and now we've landed at a stage of Consumer Duty. The FCA has consistently viewed improving consumer outcomes as a key priority through successive business plans. This is still a key focus through 2022, 2023 and beyond. And despite all the efforts that they've made to date, they still consider that they need to move these considerations closer to the consumer impact, closer to the point of sale, and embed consumer outcomes in the decision making of firms. Next slide, sorry. The FCA went through a process of identifying practices that they considered caused consumer harm. This included things such as misleading information in its presentation or its format or how it's communicated to consumers. Products that failed to deliver reasonably expected benefits by the consumers. So these are products that just were not fit for purpose and they didn't work, or they didn't work in the way the consumers expected. Products that demonstrated no fair value, so there's limited or no value to the product provided to the consumers, high commissions or limited product premium, and poor consumer support and outcomes. The inability or practices that hindered consumers engaging with their providers, intermediaries and insurance providers, to act either in terms of updating policies or cancelling policies, and exploits the information asymmetries in the chain. So what's the difference in the new Consumer Duty? First and foremost, we've got a new principle. Principle 12 replaces Principle 6 and 7, which are no longer applicable for retail businesses. Firms must act to deliver good outcomes for retail consumers. This is thinking about the outcomes for consumers at every point in the journey. So from sales and premium to credit control activities through to complaints handling, claims, and servicing of those clients, including cancellations. The cross-cutting rules that are coming in under the duty also intended to act in good faith, ensuring companies consider the outcomes of those clients and consumers throughout the journey, and avoid unforeseeable harm to the retail customers and enable the support to help customers pursue their financial objectives. The Consumer Duty itself provides 4 specific outcomes: products and services, price and fair value, consumer understanding, and consumer support. If we have a look at somewhat more detail in those, in the cross-cutting rules, The ability to act in good faith, so firms must act in good faith at all stages of the consumer journey, during the whole life cycle, from design and distribution of the products. The requirement to act in good faith does not create a fiduciary relationship where it does not already otherwise exist between the firm and the customer. But we need to be looking at ensuring that products are designed with features that don't exploit consumer behavioural bias in order to create demand for the product. They don't add unnecessarily or difficult variations or additions to products that mean it could reduce the ability for clients to compare products from other competitors, and designing products that they must offer good, fair value. So pricing and charges are presented in a way so that they're able to understand the complete cost of products, avoiding foreseeable harm. So consider the information available concerning unreasonable barriers or unreasonable additional costs as part of the firm's customer service propositions. So, and putting things right when mistakes occur. Key to this really is making sure that products are as easy to change or get out of and cancel as they are to get into in the beginning. And being accessible when customers have questions. Currently, the FCA observes the asymmetry of information between retail customers and the marketplace, and they're looking to help customers upskill themselves, but also get a fair understanding of the products that they're buying. And then finally, enabling and supporting. So looking at the consumer financial objectives in relation to the products or services that are being provided. It applies again throughout the customer journey and the life cycle of the products. And they can only make, customers can only take on responsibility where they've had the ability to make informed decisions. So if we consider those four specific outcomes that the FCA are looking to achieve. So first off, we've got products and services. So embed robust consideration of a product's target market needs, characteristics, and objectives in order to deliver good outcomes. Secondly, we have price and fair value. And then, although the FCA hasn't set a defined requirement for the fair value assessment, this builds on the work that is already in place around GI pricing practices and the product governance guidance that has previously been provided by the FCA. So these outcomes 1 and 2 shouldn't be new for intermediaries. Outcomes 3 and 4, however, are a slight change in tone. Consumer understanding, in that firms need to put themselves in their consumer's shoes so that they understand their point of view and the objectives and where they're coming from. And then consumer support, going back to this idea that it's going to be across that life cycle of the product, and for the consumer and the consumer support across that, again, making sure that products are as easy to get out of as they are to get into, making sure that there's no barriers across the different types of distribution that's been used, or any distribution chain, understanding where the key interactions with your consumers are going to appear in the life cycle of that product. So in terms of timelines, the implementation and the impact, as of October 2022, so a date that's already in the past, the FCA expects boards and intermediaries to have agreed an implementation plan, established processes to maintain oversight of this delivery. That implementation plan runs from now up until the 31st of July next year for open products. This is to ensure that all open products must be considered through the lens of consumer duty. There is an unwritten timeframe in this that by the end of April next year, product manufacturers must have engaged with all their distributors to understand what their distributors are doing, to understand and position themselves to reflect and embed consumer duty within their actions. The 31st of July is that absolutely deadline for all live products. And then slightly further ahead, we've got 31st of July 2024, which is to apply the duty to products and services held in closed books of business. So one of the things that we've seen through 2022 across multiple engagements by the FCA, and specifically also on consumer duty, is a more proactive early engagement by the FCA. They've been clear that they're taking a more proactive approach to supervision across the intermediary sector. And even before the delivery date for the implementation plans, the FCA released a letter asking intermediaries, participants, to make sure that they had a consumer duty or duty champion appointed to the board to help drive these discussions and this implementation plan into the business. It is expected that they will continue to monitor readiness, monitor embedding, and monitoring the plans between now and July next year. So it's likely that you're going to need to look out for increasing FCA engagement as to how you are embedding consumer duty within your businesses. What can we do and how can we help? So our approach to assurance is around the 4 key outcomes, but in products and services, we provide services in terms of reviewing product governance processes, the data collection, collation, analysis, distribution chain engagement and oversight. Around products, around pricing and fair value, reviewing and monitoring regime, how have you defined, segregated the products that you're using, how have you provided risk assessments, and how are you capturing, collating and reporting on the data that you're getting back. Review value measures. How have you considered, identified and captured the specific measures of value within each product that you distribute, and how is this embedded in firms' actions and your decision-making processes? Consumer understanding goes back to looking at those products, making sure there's relevant information and communication based on the target market and consumer characteristics for each of these. How do the firms equip their retail consumers with information to make informed decisions through advised and non-advised sales? And consideration of the life cycle of products and services, again, talking through both setup and sale, servicing and maintenance, claims and complaints handling, close down and cancellations. And lastly, consumer support, assessing the consumer processes throughout the life cycle of the product, distribution and communication channels, cancellation and complaints handling, journey analysis and enhancements. For a number of clients, this could be including where complaints are handled, how information is captured, and how you're going to use that information to review and update products in the future, and assessing consumer base of vulnerable characteristics and aligning the services that best meets their needs. Thank you very much for listening to me. I will pass over to John, who's going to talk about an M&A update. Thank you.
Richard, thanks very much. Morning or afternoon or evening for those of you tuning in. Thank you for downloading and watching this recording. I just wanted to share with you a number of observations from our work over the last sort of 12 months or so in transaction services. We've been carrying out a number of due diligence projects on buy side and sell side, and a number of MBO projects. I just wanted to sort of bring all of that together to feedback. I guess it's sort of no secret, really, that the last 12 months or so has brought a new territory, I guess, in terms of deal pricing, in terms of probably all-time highs for insurance intermediaries of all shapes and most sizes. We've definitely seen that top-end headline price filtering down into our some of the smaller deals that we've been doing, and it has been changing the buying decisions of those acquirers sort of further down the chain. So definitely a step up in in overall multiples. I guess what has also happened at the same time is that we've seen a lack of large targets in the market. Pretty much all of those larger brokers of 5 million EBITDA plus have been purchased already. And so we're starting to see the sights of the acquirers turning to smaller deals, and their methodology of carrying out those deals changing as well. We've seen you probably have come across it. The hub and spoke model is being widely adopted by a number of acquiring businesses, whereby there's some kind of devolution of that acquiring out into hubs, which allows for smaller deals to be carried out at generally a lower cost and with a bit more efficiency. We're still seeing new entrants coming into the market, and those new entrants in terms of roll-ups and buy and build projects. So any of those entrants coming into the market need a platform. And again, we're seeing the size of that platform business coming down. So the investors, for example, will look at smaller businesses than they may have historically as a platform to get into the market. On the flip side of that, whether it's partly driven by the interest higher up, we are seeing a number of MBO projects and new startups coming into the market. I guess some features of those, or features of them, not all of them, we're seeing people that have historically had businesses exited the market, doing new projects with a relatively short time scale. So maybe a 5-year project to acquire a number of businesses, get it to 5 or 10 million EBITDA, with a specific view to exiting to an existing consolidator or one that will be there at the time. So very specific projects to do these sort of subscale roll-ups to sell on, which opposes to a more traditional broker that's built up over 20 or 30 years. Again, partly driven by the interest in the sector, we're starting to see more appetite for minority interests coming into the market, and high net worth and family office style investors coming into the market to support new projects. And then the larger traditional PE market is still interested in coming in, and quite often what we're seeing is those businesses that are of platform scale are receiving significant pricing uplifts because a PE firm wants to use that business as a platform. So it's got a platform price in there. It's not just a regular deal, if you like. We're seeing banking lending seems to be reducing as a way of doing transactions, although saying that, we were just on a call earlier before recording this with a new project that was bank debt led, on smaller scale, but there's definitely appetite out there up to a level. Next slide, please. One other factor that's sort of come through probably in the last 12 months or so is deals actually falling over. Now, I guess of those that have fallen over, it's been because there's been a weakness in that business related to the issues that Richard was talking about earlier. Both of those firms that I've got in mind failed due to potential issues that would arise following the full implementation of the consumer duty. One had premium finance type related issues in terms of premium finance pricing. Possibly they were weaker businesses that have come to the market that wouldn't have done, say, 2-3 years ago. Again, there's a because of the state of the demand in the market, I think we're seeing people coming to sell that may not have or may not have been ready previously. I'm saying that we're still seeing, a number of businesses that are of scale coming into the market that we've certainly never come across before. And I can only think that again, the pricing is drawing out people that historically hadn't thought about selling, or they're seeing that the time is right to sell. So it's an interesting dynamic on that front. Again, same trend in terms of implications of a lack of scale and a lack of businesses for sale. With scale, we're seeing acquirers looking for different types of businesses and different geographies. So brokers looking at MGAs, brokers looking at overseas territories, particularly across Europe, and not just sticking to a pure sort of Brexit solution, but just using different territories as a means of expanding, because those markets and those geographies aren't quite so hot, I suppose, in terms of pricing multiples. So there's potentially benefits to come from that. Linked back to some of the pricing issues or the problems with that, it's very difficult to get a succession project completed, particularly when the sellers start to look at a comparison between what's possible under, say, a traditional debt structure in an MBO versus what the firm may sell for to a private equity or consolidator. There's usually quite a significant price differential arising, and therefore, what we've seen a few examples of is where the team that were effectively the MBO team have had the discussion with the owners, and effectively the owners said, the differential is so much, we can share some of that upside with you, and still just sell to a third party and sort of split the difference, but ultimately with an outright sale going ahead. So very difficult from a seller's point of view to do a succession. We're seeing potentially some of the competition across advisors contributing to pricing uplifts. So there's quite a lot of commitment, I suppose, to achieving certain prices, and being a bit more aggressive, I suppose, in some of the pricing that we're seeing in the market. So in effect, an advisor committing to a firm to achieve a certain multiple for that kind of business, in a bid to be successful in getting that mandate for the sale. Again, because there's a clearer route to the sale being achieved at a good price. From a personal point of view, across the market, we're seeing the professional services firms, at almost capacity, given the volume of deals that are going through. Don't panic though. We are all kind of working together across firms to help each other out in terms of getting deals done. So don't worry about that. Next slide, please. So we've talked about the sort of smaller acquisitions a little bit, but I just wanted to go through that concept in a little bit more detail, just because it's probably going to be a trend that sticks with us for a while. Ultimately, there are many more smaller brokers available for sale than larger ones. So the hub and spoke model is, as it says, we've got the centre as the hub and the spoke of regional businesses that are carrying out effectively their own deals supported by the centre. Why bother with that kind of structure? Because ultimately, buying lots of smaller brokers is tough work. Well, the pricing multiple For some consolidators might be, say, 50% of the ultimate exit multiple. So if we're buying somebody at 7 times and selling at 14, or buying at 8 and selling it at 16, there's quite a lot of arbitrage in just the scale that we've got there. So it can be quite an attractive proposition if we can get the numbers up in terms of those deals being done. It's possible to use in-house due diligence, because they're potentially less complex and risky transactions. But it's key to be focused on the integration. You've still got quite a lot of work to do on each deal, so getting them built into the business, integrated system-wise, closure of the legal entities, getting that business on board your main trading platform is key. But you've got less time to spend on thinking about those integration issues for each deal, just given the volume of transactions that you need to do. The deal costs are relatively high, so we are seeing a number of firms trying to simplify and standardize the due diligence process, for example. So using the same providers, using the same lawyers, standardizing things as much as they can, which does work. So it can deliver some real value to you if you can get the process working right, get the right targets, and get a clear focus. Underlying all of that, I guess one message is just it still is a huge management burden to onboard these businesses, deal with management teams, and get them on board. So don't underestimate the management stretch of doing multiple smaller transactions. Okay, next slide, please. So as part of the due diligence process, I guess, that we go through, we see a number of themes coming out of those projects that are very, very common. And I just wanted to take you through those. So many of you will look at these and go, well, that's what we're seeing on a daily basis. But when we ran the live version of this event, quite a few people came up afterwards and said, well, I'm glad we're in the same camp as everybody else. So if we just run through a few of these, I guess you will be familiar with many of them. So number one key risk item, I guess, is client money, not only from a risk point of view, but from a occurrence of problem perspective as well. So clean audit opinions, absolute classic for us. Many smaller firms that are being acquired have used a smaller local audit firm that have issued clean audit opinions. We kind of joke about it internally, but it comes up a lot, and then invariably what happens is we come along and do a review, and then there are significant issues within that firm. In many cases, it probably should have been an adverse opinion that should have been issued rather than a clean audit opinion. There's a mixed reaction, I guess, from acquirers. If it's really bad, we sometimes see the deal paused, and then the issues have to be resolved by the seller before the acquisition. In some cases, we get diverted off the due diligence to go and help that firm deal with those client money issues, or one of our other colleagues might step in as a separate project to do some work. If it's less severe, because acquirers are so familiar with those issues, then you can tend to work that into the transaction and probably deal or resolve with those issues before completion. One positive out of all of that is that the FCA's attitude towards reported issues, from our perspective anyway, is maintaining or being quite consistent, i.e. they're expecting smaller firms that have poorer compliance, they're used to the clean audit opinions from the smaller audit firms, which is not great. And provided the acquirer takes a sensible view to bring it into their client money environment, the FCA can get themselves comfortable that it's a positive outcome. So we're not seeing deals falling over because of that. Second issue, almost all transactions where there's any kind of group, we will see potential issue with group recharges or management charges from Topco or intra-group, where the group hasn't been VAT registered or the entity hasn't been VAT registered, because the usual response is, well, we're an insurance intermediary and there's no need to register for VAT. When you've got that group situation, you obviously get VAT on the group recharges. Reverse charge is also an issue. Again, we see lots of firms that use Google ads, for example, and those Google ads will either come from mainly Dublin, Ireland, or sometimes they used to come from Luxembourg. One other common one just to keep an eye out for are software development costs, where you're outsourcing the software development, and that quite often comes from an overseas jurisdiction. And of course, we should be applying the reverse charge VAT to those overseas charges, and many firms don't, which can be expensive to resolve. It's very common for smaller intermediaries to use cash as the basis of their income recognition. Again, funnily enough, I was talking about this earlier in the context of cash flow lending. Actually, it makes everybody's life quite straightforward if you keep everything in cash, but that isn't UK GAAP. But so we have a twofold impact of that. One is resolving the income recognition side, and probably the more painful part of that is dealing with the tax consequences and dealing with the revenue on reporting your historical tax position and income. And it makes the deal quite complicated to do, because everybody has to agree what the income should have been and agree that there's no risk with HMRC in terms of disclosing all of that and dealing with it. So from a personal perspective, less of a worry over the control implications of that, but the hassle of dealing with that issue is shouldn't be underestimated. One that's probably cropping up more than it historically has, I guess, because of the scale of transactions that are going through, is problems with the underlying data that we're being given as proof of the revenue. So the core part of our due diligence is getting a listing of all the clients and the revenue against each of those clients, which agrees to the revenue figure in the financial statements. We've been presented on a number of occasions with a list of clients and income that doesn't agree, which obviously causes huge headaches when you're trying to validate the ultimate recurring revenue of that business. So if you're a seller, just make sure that it's easy for you to get that listing of clients, listing of income that ties back to your normal financial information. Lifestyle expenses is a classic and still continues in the market. Everybody would be aware of those issues, but very, very common in the smaller firms still. And as Richard talked about, consumer duty issues are, if you have issues with that and pricing practices, you have had to do something about it, and if you haven't, that can be a real problem for firms. In terms of the actual shape of deals and what's being presented, the overarching shape, I guess, hasn't changed too much. We're seeing potentially a slightly more favourable set of terms to sellers in terms of upfront splits. So, you know, we were at sort of 60-20-20. We're now, you know, seeing deals where there might be 75% upfront, again, depending on the business, but there's a little bit of a shift with more upfront. What is coming through, I suppose, more strongly is just more allowance for you know, acquisitions that you've already done, the normalization adjustments, bringing up that EBITDA, and also sort of sharing of synergies on the cost side, or uplifts on commission with the businesses coming together. So yeah, firms are keen to do the deal, need to get to a price that works for the seller. It's finding a deal in the middle that's probably more generous than, again, it might have been a couple of years back. Factor is still probably the most desirable system out there in terms of non-London market deals. If we link that back to yeah, the trend to go towards more sort of smaller deals, if you're an actress as a seller, it's a no-brainer for a you know, an acquirer that's already on actress to be more interested in you, because there's less hassle in bringing your business into their core trading platform. So that, you know, it just is a natural conclusion, I guess, as most of the acquiring businesses in the market are an actress. We still don't have an equivalent on London Market or MGA. It'll be interesting to see over the next few years whether we do get a more dominant system coming through on that side of things. We are still seeing sellers underprepared and under-resourced to complete the transactions. Again, whether we're seeing a slight rush to bring things to the market, possibly, or we're seeing smaller businesses coming to the market, but you know, we have had instances where acquirers have effectively asked us, rather than almost do the DD, to actually give the sell side support to these people as kind of execution only transaction, just to help it get across the lines of data recreation that we spoke about earlier, or help with client money issues, or help with tax issues. Just, you know, give the guys some help to get their business into shape. And in some cases, that's even where there's a corporate financer in place. But that advisor's really just acting in the sales capacity, not in a technical capacity. Next slide, please. So the more tricky question is, where is everything heading? I think we are going to continue to see a trend towards the smaller deals, and the market is already kind of changing and adapting to take these kind of smaller transactions on. We're definitely seeing the debt multiples coming down because of, you know, higher servicing costs due to interest. You know, those businesses that are reliant on those heavy leverage multiples on the debt side of things are probably going to come under a little bit of pressure. But we've got the US businesses and the listed businesses with less debt, you know, in potentially a relatively stronger position. We've seen the US GBP exchange rate swing back slightly, but US investors and US consolidators are still in a relatively strong position as well. One comment that came in after our presentation on the day was that one advisor had just seen his strongest ever priced deal go through that week. So I thought we were broadly at the peak, but possibly not. A couple of comments I guess we've had from potential sellers that they are kind of, I suppose, wise to the private equity model in terms of, you know, selling to a firm and there's a certainty about a resale in 4 years and then another resale in another 4 years. So what what does that mean for the firm? So I think there'll be a bit more differentiation between potential acquisition models and how that's communicated to potential sellers. People are concerned about that, but as I said, money does talk in these scenarios. I'd already mentioned about the startups with the specific life cycle. I can see that continuing. If we've got the strong demand continuing, and again, new ideas creeping through into the market, where we're seeing branch-based business models popping through again. Possibly post-pandemic, people are getting used to working from home. New generation of workforce coming through that want to work from home. Can we start to build brokers that are entirely virtual or online? I can definitely see that coming through. And again, being potentially quite attractive to more established players that need a new model to fit with a new workforce. And have we seen the peak? Well, I thought we kind of had until I'd had that conversation on the day. So, but we will see. Okay, I think that is the end of my slides. So I'll just close by saying thank you very much for joining us on this version of our breakfast briefing. Thank you to Richard and Paul earlier. And of course, if you've got any questions for any of the team, us or the wider insurance team at PKF, then please do get in touch with any questions. I think you've got our details on the first couple of slides. So thank you very much.